Welcome to the Big Fat Whale channel. Today we are going to bring you back in history to the Great Depression from 1929 to 1939. We will run through what transpired during that era. Most importantly, will the market be prone to another Great Depression, given the current market conditions? Let's begin. The Great Depression was the greatest and longest economic recession in modern world history. It began with the U.S. stock market crash of 1929 and did not end until 1942. Economists and historians often cite the Great Depression as the most catastrophic economic event of the 20th century. A good starting point would be the preceding period that led to this overinflated stock market. During the 1920s, the booming stock market roped in millions of new investors, many of whom bought stocks on margin. The 1920s also witnessed a larger bubble in all kinds of credit. In the years after the 1929 crash, the credit-based economy fell apart. Overconfidence during the Roaring '20s created an unsustainable stock market bubble. Overnight, many people lost their businesses and life savings, setting the stage for the Great Depression. Speculative frenzies affected both the real estate markets and the New York Stock Exchange, NYSE. Loose money supply and high levels of margin trading by investors helped to fuel an unprecedented increase in asset prices. The lead up to October 1929 saw equity prices rise to all-time high multiples of more than 30 times earnings. The benchmark Dow Jones Industrial Average increased 500% in just 5 years. The combination of these factors would ultimately cause the stock market crash. On October 24, 1929, as nervous investors began selling overpriced shares en masse, the stock market crash that some had feared happened at last. A record of 12.9 million shares was traded that day, known as Black Thursday. This marks the start of the Great Depression. As consumer confidence vanished in the wake of the stock market crash, the downturn in spending and investment led factories and other businesses to slow down production and begin firing their workers. For those who were lucky enough to remain employed, wages fell and buying power decreased. While the crash likely triggered the decade-long economic downturn, most historians and economists agree that the crash alone did not cause the Great Depression. Nor does it explain why the slump's depth and persistence were so severe. A variety of specific events and policies contributed to the Great Depression and helped to prolong it during the 1930s. By increasing the money supply and keeping the interest rate low during the 1920s, the Fed instigated the rapid expansion that preceded the collapse. Much of the surplus money supply growth inflated the stock market and real estate bubbles. After the bubbles burst and the market crashed, the Fed took the opposite course, by cutting the money supply by nearly a third. This reduction caused severe liquidity problems for many small banks and choked off hopes for a quick recovery. After Black Thursday, the Fed failed to come up with a cash injection between 1929 and 1932. Instead, it watched the money supply collapse and let literally thousands of banks fail. It led to a collapse of the confidence of the financial system. The Fed's harsh reaction, while difficult to understand, may have occurred because it feared that bailing out careless banks would only encourage fiscal irresponsibility in the future. Some historians argue that the Fed created the conditions that caused the economy to overheat and then exacerbated an already dire economic situation. All in, the lowest point of the stock market was 43 in June 1932, and that was close to a 90% drop from their peak in October 1929 of 380. Many lost everything, and it was a tough 1930s for most. They lost faith in Wall Street. Despite best efforts by President Franklin Roosevelt with the New Deal in 1933, whereby the Fed ramped up their money printing prowess and implementing numerous government policies, the economy just hobbles along and the unemployment rate stays high. It was a forgotten decade, not only for the U.S. but for the rest of the world. The U.S. only officially crawled out of the Great Depression when the U.S. decided to enter World War II in 1942. Unemployment went down from 8 million to 1 million. Is the Great Depression likely to happen in the 2020s? Our thoughts are, with the central bankers gaining good reference form historical events, the severity of the Great Depression is unlikely to reoccur. The central bankers would likely be reactive, rather than passive. However, a price correction of around 50% is still possible as markets don't move up on a parabolic style. Given the huge government debt, and longest-running bull run of around 12 years, a correction on the cards would not be a far-off thesis. With this, I hope everyone has enjoyed the content. Appreciate if you could subscribe to our channel and like our video you find it insightful. See you in our next video.